tariffs may put extra pressure on the Fed to cut rates again, as Christina was saying. Joining me now, Ben Phillips, the Chief Investment Officer at Invent Shares. Before we talk about the Fed, let's just factor in this rather extraordinary development this afternoon, the possibility of of a 10% tariff, and the market. I mean, it took you by surprise. It took everybody by surprise. How significant is it?
Well, it matters, and I think China's looking to the U.S. just to see some policy clarity. And I think when there's so much volatility and erraticism in the trade policy, it makes us question whether or not we're going to get a deal done between now and the 2020 election even. So China, we've seen reports that China's waiting. They think the longer they wait, the better the deal they get, and this is giving them more reason to bide their time.
Right, but the last thing this market needed, a market that was already febrile and somewhat nervous, was gasoline poured on it with the sort of thing that we got from the president this afternoon.
Yeah, I mean, the market is, I guess they were a little encouraged by the Fed rate cut, and then the Fed came out and said maybe we're one and done, and now we have trade back on the table. So it feels like the same things we're talking about, month in, month out. It's trade, it's the Fed. That's what's driving markets right now. It's these big, exogenous factors that are very hard for investors like us to really price in.
So how do you? I'm glad you took me there because that's why you're here. Tell me, I mean, in terms of an investment strategy, what does one do when, the Fed might cut again and it might not? And they were quite open about that. It's not necessarily one and done. It could be a several. And you've got a president doing what he's doing. What's your strategy?
Yeah, well, I mean, the strategy, if I were a personal investor, I'd think about just owning a diversified grouping of assets. I'd think about having some alternative exposure, having some commodities like gold and precious metals, having some things that can offset some inflation. I would also think about just having more bonds. I mean, where are we going with rates next time when we have a recession? There's not much room, but we're probably going negative in the U.S. And I know that's a controversial thing to say, but that's probably where we're going, and that's actually going to be good for U.S. Treasuries. Stocks, I'm still in the camp that over time people should probably be trimming. People seem to be too exposed to tech stocks, in my opinion, and those are still cyclical, and I think people forget that. Those are going to do worse than the market most likely in the next downturn. So I just think, being diversified, being cautious, and having a lot of dry powder like cash and short-term securities is a good stance right now when there's so much volatility and uncertainty.
Good to see you, sir. Thank you. I appreciate it.